Where is the highest volume of financial transactions happening every day in the world? If your guess is right, it is the global payment industry involving banks. It handles an astonishing 5 trillion US dollars every day. Coming in next is the stock market that processes a remarkable 200 billion US dollars each working day. Now we are diving into the fascinating world of finance as we explore the top performing stock markets around the world. We cover 40 prominent stock market indices spanning 44 countries across the globe. Let us first know the difference between a stock market and a stock exchange. A stock market is a collection of stock exchanges. It broadly refers to all stock exchanges operating within a specific region. A stock exchange is a place where stockbrokers and traders come together to buy and sell different stocks. It is an infrastructure that facilitates trading. For example, United States stock market has two major stock exchanges and nine small stock exchanges. Have a look at the screen for all the stock exchanges in United States. The two major stock exchanges are NYSE and Nasdaq. A stock market index measures the performance of a stock market or a subset of the stock market. It helps investors to compare the current stock price levels with past prices to calculate the market performance. Have a look at the types of stock market indices by coverage. There are five types of stock market indices by coverage: global coverage, regional coverage, country coverage, exchange based coverage, sector based coverage. Whether we want to invest $1,000 or $1 trillion in stock market, we need to analyze 10 key factors that influence stock market performance. Factor number 1: economic indicators. Employment data. High employment rate boosts investor confidence by signaling economic growth. Consumer confidence. High consumer confidence suggests robust consumer spending and positively impact stocks. GDP, gross domestic product. It is the total value of all goods and services produced in a country in 1 year. GDP per capita is calculated by dividing the GDP of a country by its population. However, a more precise measure of a country's wealth considers inflation rates and the cost of local products and services. Strong GDP growth usually supports higher stock prices. Let us look at the GDP and GDP per capita of 44 countries. Top three countries by high GDP are United States, China, and Germany. However, China GDP per capita rank is 40 because of its huge population. Though 8 out of 10 richest persons in the world are in United States, US GDP per capita rank is 5. Top 4 richest countries by GDP per capita are Luxembourg, Switzerland, Ireland, and Norway. Population size and income distribution affect GDP per capita. Switzerland is the second richest country by GDP per capita. Ireland and Norway are the third and fourth richest countries by GDP per capita. Luxembourg is the richest country in the world by GDP per capita. That means each Luxembourg citizen, on an average, has more income than other countries' citizens. Factor number 2: monetary and fiscal policies. Government spending. Fiscal stimulus or budget cuts can directly affect economic activity and market sentiment. Central bank policies. Central bank actions such as changes in interest rates or quantitative easing can influence liquidity in stock market. Central bank's name varies across nations. For instance, Central Bank of the United States is known as Federal Reserve or simply Fed, whereas Central Bank of the United Kingdom is known as the Bank of England. Stock market frequently discusses Fed rate cuts Higher interest rates can reduce stock prices as borrowing costs increase for companies, potentially slowing growth. Moderate inflation is often seen as a sign of a growing economy, but high inflation can negatively impact profits and consumer spending. Central banks try to balance the interest rates and inflation to maintain economic stability. Let us examine the interest rates and inflation rates across different countries. Brazil has a double digit interest rate. Russia also has double digit interest rate. Turkey has the highest interest rate and inflation rate. Factor number 3, geopolitical events, trade policies and tariffs. Changes in trade agreements or tariffs can impact specific sectors and overall market performance. Wars and conflicts. These often lead to high market volatility and can affect stock prices. Stock markets around the world crashed when Russia-Ukraine war escalated on February 24th, 2022. Political stability. Stable political conditions usually foster positive market sentiment. Have a look at the 12 factors to determine the political stability rating for each nation. Let us examine the political stability of various countries by Fragile States Index. Fragile States Index shows the political stability of countries on a scale from 1 to 120. A higher score signifies greater vulnerability and less stability. Political stability rank 1 to 11 goes to Finland, Denmark, Switzerland, Canada, Ireland, Luxembourg, Netherlands, Australia, Sweden, Austria, and Germany. Political stability rank 12 to 22 goes to Portugal, Slovenia, France, South Korea, Japan, Belgium, Malta, Slovakia, Estonia, Lithuania, and Czech Republic. Political stability rank 23 to 33 goes to United Kingdom, Italy, Latvia, Poland, Spain, United States, Croatia, Hungary, Bulgaria, Romania, and Israel. Political stability rank 34 to 43 goes to Cyprus, Greece, Saudi Arabia, Indonesia, China, Brazil, India, Philippines, Russia, and Turkey. Factor number 4, market sentiment. Optimism or pessimism among the investors can significantly impact market trends, particularly foreign direct investment (FDI). The FDI confidence index represents a weighted average of responses indicating the likelihood of direct foreign investment in a market over next 3 years. Its score is on a scale from 0 to 3. 0 indicates the lowest confidence, 3 indicates the highest confidence. Have a look at the FDI confidence index of various countries. United States, Canada, and China have the highest confidence index. Other countries have similar FDI confidence index. Factor number 5, global markets. Stock markets in major economies such as United States, European Union, and China can influence other stock markets. When US market sneezes, other markets catch the cold. A strong or weak domestic currency can also affect export oriented companies and overall market sentiment. A strong currency has some benefits and drawbacks. Have a look at the benefits and drawbacks of a strong currency. As of January 10, 2025, Kuwaiti dinar is the world's most valuable currency at about 3.24 US dollars. Let us look at the other countries compared to US dollar. UK's pound is the strongest currency among 44 nations. Switzerland, Austria, Belgium, Croatia, Cyprus, Estonia, Finland, France, Germany, Greece are stronger than US dollar. Ireland, Italy, Latvia, Lithuania, Luxembourg, Malta, Netherlands, Portugal, Slovakia, Slovenia and Spain are also stronger than US dollar. Canada, Australia, Bulgaria, Saudi Arabia, Israel, Poland, Romania, Brazil, Denmark and China are weaker than US dollars. Hong Kong, Sweden, Czech Republic, Turkey, Philippines, India, Russia, Japan, Hungary, South Korea, and Indonesia are also weaker than US dollar. Factor number 6, technological and industry developments. Regulatory changes. New regulations can either help or hinder stock market performance. For instance, stock exchange regulator in the United States, the Securities and Exchange Commission, SEC, ensures that stock market should remain fair and transparent. This helps to maintain confidence in the integrity of financial markets, which is crucial for brokers, dealers, investment advisors, and mutual funds. Innovation. Breakthroughs in technology or other fields can fuel optimism in stock market. For instance, Nvidia share price skyrocketed by an astounding 194% in 2024, riding the wave of the artificial intelligence boom's rapid rise. It became the second largest company on Nasdaq, surpassed only by industry titan Apple. Have a look at the technological breakthroughs in 21st century, from first podcast to world's fastest computer. Now look at the emerging technologies in various sectors of the economy that can influence stock market. Factor number 7, natural and environmental factors. Earthquakes and hurricanes can disrupt industries and adversely impact stock markets. Stocks and bonds may face prolonged losses, taking months or years to recover. Conversely, scarce commodities can appreciate due to the scarcity driven by supply and demand. For instance, 1995 Kobe earthquake severely affected the stock market, causing a 5% drop in the Nikkei index, while the 2008 earthquake in China led to a decline of over 15% in the Shanghai Composite Index. Factor number 8, speculation and technical factors. Market manipulation. It involves deliberate attempt to interfere with the free and fair stock market operation. Practices like pump and dump schemes can cause stock prices to rise or fall dramatically. Market manipulation is illegal in most countries. There are 6 types of stock market manipulation: spoofing, layering, ramping pools, cornering the market, squeeze, bull bear ride, and pump and dump. Let us have a closer look at them. Algorithmic trading. High frequency trading can intensify fluctuations in stock market. Factor number 9, black swan events. Unforeseen events such as pandemics COVID-19 or financial crises such as Lehman Brothers collapse can cause sharp and unpredictable stock market reactions. Let us look at some important stock market crashes in 21st century. Dot-com bubble in 2000, September 11 attack in 2001, market downturn in 2002, Chinese stocks bubble in 2007, and US bear market in 2007. Financial crisis in 2008, Dubai debt standstill in 2009, European debt sovereign crisis in 2010, flash crash in 2010, and market fall in 2011. Chinese stock market crash in 2015, stock market sell-off in 2015, cryptocurrency crash in 2018, and COVID-19 breakout crash in 2020. Stock market crash in 2022. Russia stock market crash in 2022. Chinese stock market crash in 2024. Japan stock market crash in 2024. Factor number 10, corporate performance. Investors primarily concentrate on corporate performance, when evaluating stocks, indices, or mutual funds. Earning reports. Better than expected corporate earnings can drive stock prices higher. Dividends. Consistent or increasing dividends can attract investors. Guidance and forecasts. Positive future outlooks from companies can boost stock prices. While past performance does not guarantee future earnings, it can offer a valuable insight into how effectively the company has managed its finances. Let us analyze the 5-year performance of 44 prominent indices across the globe. Top 5 indices are BIST 100, Nasdaq Composite, Nifty 50, Taiwan Weighted, and BSE Sensex. Rank 6 to 11 are Rank 12 to 17 are Rank 18 to 22 are Rank 23 to 29 are Rank 30 to 35 are Rank 36 to 40 are. Let us examine the 3-year performance of 40 prominent global indices. Top 6 indices are BIST 100, Budapest SE, Nikkei 225, IBEX 35, Nasdaq Composite, and Nifty 50. Rank 7 to 12 are Rank 13 to 18 are Rank 19 to 25 are Rank 26 to 31 are Rank 32 to 37 are Rank 38 to 40 are. Now look at the 1-year, 3-year and 5-year performance of 40 global indices across the globe. The ranking on the screen is on 1-year performance. Top 10 indices are Nasdaq Composite, Budapest SE, Taiwan Weighted, BIST 100, TA 35, S&P 500, China A50, Hang Seng, Nikkei 225 and DAX. Rank 11 to 20 are S&P TXX Composite, Bell 20, IBEX 35, Shanghai SSE Composite, Dow Jones, AEX, DJ Shanghai, FTSE MIB, Small Cap 2000 and SGSC Component. Rank 21 to 30 are Nifty 50, BSE Sensex, Eurostox 50, ATX, Nifty Bank, S&P AXX 200, FTSE 100, SMI, OMX 30 and PSEI Composite. Rank 31 to 40 are Tadawul All Share, PSI, CAC 40, IDX Composite, WIG 20, MOEX Russia Index, BOESPA, KOSPI, S&P BMV IPC and RTSI. How to invest in foreign stocks? Investors have several options for investing in foreign stocks, which can vary by country. For example, Americans can typically invest in foreign stocks through 5 main approaches. 1. American Depository Receipts, ADR. American Depository Receipt allow investors to easily buy and sell shares of foreign companies on US stock exchanges. By listing ADRs, foreign companies can establish a trading presence in American stock market. For instance, the Chinese e-commerce giant Alibaba has listed its ADRs on the prestigious New York Stock Exchange. 2. Global Depository Receipts, GDR. GDR is a type of depository receipt issued by a bank to facilitate the trading of shares of foreign companies in international markets, typically in Europe. GDRs are denominated in US dollars, euros, and British pound. These GDRs can be traded on London Stock Exchange, Luxembourg Stock Exchange, as well as exchanges in Singapore, Frankfurt, and Dubai. 3. Foreign direct investment. Investors have 2 main options for directly buying foreign stocks. They can open a global account with a broker in their home country, such as Fidelity, E-Trade, Charles Schwab, or Interactive Broker. Alternatively, they can open an account with a local broker in the target country. For instance, The Monex Boom trading platform based in Hong Kong provides investors to access Hong Kong stocks as well as 11 other markets. However, it is crucial to avoid brokers that are not registered with the appropriate regulatory authorities, such as US Securities and Exchange Commission (SEC). Foreign direct investment is not suitable for retail investors. It has additional costs, tax implications, currency conversion, and research. For global mutual funds. For investors interested in global markets but wanting to avoid complexity, global equity mutual funds offer a simple solution. Global mutual funds come risk profiles from aggressive to conservative and can be region specific or country specific. Investors can choose between actively managed funds or passive index funds that track overseas stock prices. 5. International exchange traded funds ETF. ETF offers investors a convenient way to access foreign markets. Choosing the right ETF can be simpler than building a portfolio of individual stocks. ETFs provide exposure to multiple markets or a single country. These funds cover a range of investment categories, including market capitalization, geographical region, and sectors. The stock market offers exciting opportunities for investors seeking to diversify their portfolios and earn robust returns. However, we encourage you to thoroughly research and carefully check any investment opportunity before taking action. We hope this video is both informative and inspirational. Have an amazing day